Save thousands on your Singapore taxes in 2025 with 3 digital-first strategies that work whether you're a fresh graduate or seasoned investor. Hey friends, welcome back to the channel. I'm Iggy, and if you're new here, we break down complex financial topics into practical advice for Singaporeans. With over 650 videos and 300,000 watch hours, we've helped thousands navigate everything from CPF Top Ups to stock market basics. Today's video might save you more money than any investment tip. We're diving deep into IRA's new tax systems and relief programs. Let me show you how the upgraded MyTax Portal can help you manage your taxes. Think of it as a central place to access your tax information and file your returns. MyTax Portal integrates with several government agencies to pre-fill some of your tax data, which can save you time. However, it's important to understand what information is automatically included and what you need to provide yourself. While MyTax Portal pulls data from some government sources, it doesn't automatically gather information from all platforms. For instance, income from gig economy, work like driving for Grab, earnings from online stores like Shopee, and rental income managed through property agents like PropNext are generally not automatically reported to IRS through MyTax Portal. You are responsible for accurately declaring these income sources. It's a common misconception that digital filing means automatic tracking of all income. The system can't read handwritten receipts or track cash transactions. For example, a hawker stall owner who receives cash payments for catering orders needs to keep accurate records of those transactions themselves. Relying on automated systems for income tracking can lead to inaccurate reporting and potential issues with IRAS. Remember, accurate record keeping is crucial for fulfilling your tax obligations. One of the best ways to save on your taxes in Singapore is by leveraging the SkillsFuture Tax Relief. The government provides up to $5,500 in relief for approved courses, reducing your taxable income by that amount and potentially leading to significant savings on your tax bill. To qualify, the course must be from the SkillsFuture approved list and directly related to your current job. For instance, a nurse taking a SkillsFuture approved data analysis course relevant to their work could claim this relief. It's important to note that not all online courses qualify, so always verify that the course you're interested in is on the SkillsFuture approved list before enrolling. A helpful tip: if your assessable income is $22,000 or below, you can defer your claim for course fees relief. This can be advantageous if you're unsure about meeting future income requirements. Contributing to your special account or retirement account, or topping up your parents' retirement account can indeed provide tax relief. However, the $14,000 figure you mentioned is a combined limit, not separate. It includes cash top-ups to your own special retirement account and cash top-ups to your parents' retirement account. The maximum tax relief for cash top-ups to your own special retirement account is $7,000 per year. The same goes for cash top-ups to your parents' retirement account. So the combined total is $14,000. It's wise to use the CPF calculator to assess which option maximizes your returns, especially considering your age and financial goals. While topping up your parents' account can offer immediate tax benefits and help them reach their retirement needs, younger individuals should carefully weigh this against the long-term benefits of compounding within their own CPF accounts. Now, let's talk about charitable donations. Donating to approved institutions of a public character, IPCs, does offer tax deductions. The amount you can deduct is 2.5 times the amount donated. So a $1,000 donation can indeed reduce your taxable income by $2,500. However, the tax savings depend on your individual tax bracket. In your example, someone in the 20% tax bracket would save $500 in taxes on a $1,000 donation. It's crucial to verify an organization's IPC status before donating. You can easily do this by checking the charity portal. Donating to non-approved organizations, including crowdfunding campaigns that aren't registered IPCs, will not qualify for tax deductions. As you mentioned, this can result in a missed opportunity for significant tax relief. So, always do your due diligence before donating. Let me show you how this works in real life. Mr. Tan runs a small packaging factory. Last year, he invested $200,000 in solar panels and automated machines to improve his operations. Under Singapore's accelerated capital allowance scheme, businesses can claim deductions faster to ease cash flow. For assets acquired during the basis period for YA 2024, Mr. Tan opted for the 2-year accelerated write-off. This allowed him to claim 75% of the cost, $150,000 in YA 2024 and 25% $50,000 in YA 2025. By accelerating his claims, he received $25,500 in tax savings in YA 2024 alone, based on Singapore's corporate tax rate of 17%. Instead of spreading the deductions over 3 years, he benefited from immediate cash flow relief. Mr. Tan used these savings to hire 2 additional workers and expand his production line, boosting his business growth. This is a great example of how leveraging tax incentives can support small businesses in reinvesting for expansion and innovation. As we approach the Year of Assessment 2025, there are 3 key updates from IRAS that you should keep in mind to stay compliant and optimize your tax filing. First, the total personal income tax relief cap remains unchanged at $80,000. This means that regardless of how many reliefs you qualify for, be it CPF contributions, child reliefs, or others, the maximum amount you can claim is capped at $80,000. If your total relief claims exceed this limit, the excess will not be applied to reduce your taxable income. Next, IRAS continues to enforce strict penalties for late tax payments. If you miss the payment deadline, a 5% penalty will be imposed immediately. Beyond that, an additional 1% interest per month will accrue if the tax remains unpaid 60 days after the penalty notice is issued. While these rates are consistent with previous years, it's crucial to settle your taxes promptly to avoid unnecessary financial penalties. Finally, IRAS has stepped up its monitoring of cryptocurrency transactions through enhanced reporting frameworks. Under Singapore's Crypto Asset Reporting Framework, CARF, crypto exchanges like Binance and Coinbase are now required to report user transactions to IRAS. Any profits made from cryptocurrency trading or investments, such as gains from selling Bitcoin, are taxable and must be declared in your income tax filing. For instance, a client who failed to report $12,000 in Bitcoin trading profits from 2023 was flagged during a compliance check. To avoid such issues, ensure that all taxable income, including crypto gains, is accurately reported. To ensure a smooth and efficient tax filing process with IRAS in Singapore, it's important to start early and stay organized. Begin by logging into MyTax Portal before March to review your pre-filled data. This includes employment income, CPF contributions, and other details submitted by your employer. Cross-check this information with your own records, especially if you have additional cash income or overseas earnings. Verifying these details early helps avoid discrepancies that could delay your filing. When claiming tax reliefs, prioritize strategically to maximize savings. Start with CPF Top Ups, as they not only reduce taxable income, but also boost retirement savings. You can claim up to $16,000 annually for voluntary contributions to your own CPF account and those of your family members. Next, include donations made to approved institutions of a public character, IPCs, which qualify for a 2.5x tax deduction. Finally, claim course fee reliefs for skills-enhancing courses, which allow up to $5,500 annually. Proper planning ensures you take full advantage of these reliefs within the $80,000 personal relief cap. It's also crucial to keep all relevant records for at least 5 years, whether physical or digital copies. IRAS can audit up to 5 years back, and failing to provide documentation may result in penalties or disallowed claims. Stay organized by keeping receipts for CPF contributions, donations, and course fees readily accessible. Lastly, mark key deadlines on your calendar to avoid late penalties. Paper filers must submit their returns by April 15th, while electronic filers have until April 18th. Tax bills, notice of assessment, will be issued by the end of April, and payment is due by May 31st. Missing the payment deadline incurs a 5% penalty, with an additional 1% per month for continued delays. Set reminders now to avoid unnecessary costs. Last year, many taxpayers paid late, and faced an average penalty of 380 settlements. By preparing early, claiming reliefs wisely, and staying on top of deadlines, you can streamline your tax filing process while maximizing savings and avoiding penalties. Want to supercharge your tax savings even further? Watch our just released video, The Ultimate SRS Guide, Boost Wealth, Cut Taxes Now, where we break down how combining supplementary retirement scheme contributions with these strategies can save high-income earners up to $15,350 annually.